where we blow apart the stock market and world bond markets and put them back together so that they make sense for you. I'm Forbes Markets editor John Dobis. Well, Athens, Greece was a very hot place for violence this past weekend as police and rioters crashed over the government's plans to impose austerity in the country. Higher taxes, lower spending, cutting about 150,000 government jobs, lower minimum wage, things that really angered the Greeks. Of course, symbol of American and world corporate dominance, Starbucks was burned. You had police on fire. You had rioters throwing tear gas canisters that were thrown at them, throwing rocks, and it was very ugly. But in the end, Greece agreed to make the concessions that European authorities and the IMF wanted them to make. But, you know, honey badger, all these images, the honey badger don't care. Honey badger is kind of like the investor, picking up a snake, not really caring. The images were horrible in Greece, but at least this shows that the world markets can get over a Greek default if it comes, and sickening images of violence. Here is the S&P 500 index, the SPY that tracks it, up about 0.74% today as stocks in the U.S. breathed a sigh of relief that the Greeks will make the changes that they agreed to make and that the euro may eventually move on. The euro, a risk currency, moved higher today too. We'll get to that in a second. Look at this, the financials are kicking higher. Morgan Stanley, Goldman Sachs, Citigroup, the index of bank stocks up about 0.93% on Monday. Nice day. The 10-year yield still not out of control here, just below 2.0%, 1.99% on 10-year government paper in the U.S. Let's talk a little bit about currencies, because currencies, when you have things like riots in Greece, the possible breakup of the euro itself, you have a lot of moves in currencies. Here you have the U.S. dollar. You can see from the time that the U.S. debt was downgraded in August here, the dollar, represented by the UUP, has gone substantially higher. But in 2012, as things looked like they were going the right way in Europe, risk appetite got hardier. Therefore, people sold off the dollar, which is considered a risk-off asset, and it's down from about 23 to 22 in the span of about 1 month, the US dollar, UUP. So the intermediate trend is negative there, but we're still a lot higher than we were in August. The euro has rallied, was down to about $1.27 just early in December, early in January, up now to $1.31. Looks like it has its eyes on that 135 level it wants to get back to. As risk appetite gets hardier, so does appetite for the euro. Some currencies are just going to the races. One of those is the Brazilian real. Look at this. This is the trust that holds a bunch of Brazilian real, partying like it's Carnival, which is coming right up, moving from 19 to about 21.45 in the span, well, just since 2012 began, about 6 weeks. India. Who would have thought India? All these emerging markets are coming back online. People want to get into those. As the risk appetite of the world rises, so is Indian currency. The rupiah up from 35 to 39, the fund that owns it. One more, Mexico, the Mexican peso. All you hear about are mass killings on the U.S.-Mexican border, drug lords running the country. But Mexico, look at this. The rebound in global appetite for risk has done wonders for the Mexican peso, moving the trust that owns it here, the FXM, from 71 to 79 just in the past 6.5 weeks. Not a bad deal there. So you've got the risk appetite in the world getting hardier again because things in Europe, while ugly, are moving in the right direction. Honey badger, he don't care.